Hey guys, Mr. Concilio here. We are going to go over the investing unit notes. So go ahead and start a new Google Doc, and this is our investing unit notes. And we're going to start from the top. This is actually going to be, we'll break this down over 3 sections, but we're just going to talk about the first section today, and we'll pick up the second section tomorrow. All right. So new Google Doc, investing unit notes, intro to business, whatever you want to name it. And here we go. All right, talking about investing. What is investing? Using money to participate in an enterprise that offers the possibility of profit or loss. Hopefully, when we go to invest, that's the opportunity of profit, right? Um, we shouldn't really be investing in things that over a long period of time that we're going to lose money in. That would be terrible planning and probably just not knowing what we are doing. So if we're investing for the long term, we'll talk about what we should invest in as we go. But it's not getting lucky. It's not timing the market. If it feels like gambling, you're doing it incorrectly. That is not what it should feel like. It's going to be more like watching grass grow. It's not going to be the most exciting thing, but it's going to be consistent and yeah, it's going to have really good returns. So even a small amount of money invested regularly can add up over time. So time is your biggest asset. When we were talking about over in our budget unit, and we did the retirement tab, and we saw what happened when we chose to start investing for retirement at 35 instead of 25, or 33 instead of 23, whatever it was. When we invested 10 years later, right, and we miss what I call the meat of our investing, right? We lose these last 10 years, and look how amazing these last 10 years, how vertical we get on this graph for compounding interest over time, right? And when we don't give it that much time, we just don't get that meat of the investment, that those large growth years, especially at the end, which are all so important. It is just so very important. I always encourage everybody, the quicker you can set up something like a Roth IRA, the better. Even if you're only putting $25 a month in there, $20 a month, that's 3 scooters, $7 coffees, like nothing crazy. And it just watch it multiply and compound over time. It's extremely powerful. All right. In order to do this, as we saw on the budget project, I'll keep referring back to that, we have to limit our debts, right? I gave you guys car loan debt, which can be terrible. That can be a bad debt because cars typically depreciate in value, which means that they go down over time. So you're borrowing money and paying interest on something that is going down in value. That would be considered a bad debt. Some of the worst debt that you could possibly have is excessive student loan debt. As you guys saw, some of you guys that went to different colleges, and granted, I didn't give you guys scholarships, I didn't give you guys any financial aid or grants or anything like that, and you guys are more than capable of receiving that. St. James Academy students receive like millions and millions of dollars in financial assistance for college, or I should say scholarships for college, whether that's academic, athletic, so on and so forth. But yeah, you don't want to be going $200,000 in debt to get a starting job at $40,000-$50,000. That's a very bad scenario. So you need to reduce the amount of student loan debt if you have any, and we'll talk about during the student loan or credit section. We'll talk about student loan debt and ways to avoid student loan debt altogether, which is extremely powerful. If you can come out of college, assuming that you are going to college, that you come out of college without student loan debt, that will just set you apart from everybody else right away. And the worst debt that you could possibly have is credit card debt because of the interest. The interest is just, it's overbearing. I mean, we can get up to 20, 25, 30% interest rates. That's the cost of borrowing money, usually for things that we don't necessarily need. These are usually wants. Sometimes you can get in credit card debt that's not always your fault, but that's why we don't have that emergency fund that we talked about in the budgeting unit. We have that emergency fund so we don't have to put things that are outside of our control, things that exceed our budget for one particular month, things that we can't foresee happening, and we can cover those without having to pay interest on that. Good debt, that's going to be something that appreciates in value, like buying real estate, buying a home for a mortgage. That could be potentially good debt. You're paying 3% interest, but home prices typically rise 3 to 5% each year, and gosh, even more so lately. Business loans to start your own job, to start a career, to provide jobs for you and potentially other people. Um, and student loans can increase the amount of money that you can make over time. Again, got to be really, I put student loans on each side. You got to just be really careful with the student loans. They're super dangerous, and it just, yeah. Well, again, we'll talk more about it, but they can be extremely dangerous. But they can also, like I said, increase the amount of money that you can make over time. I'll give you an example of my master's degree. So to get my master's degree, I make an extra $5,000 a year teaching. It costs $20,000 to go get my master's degree. So $20,000, I pay that back basically over 4 years. I earn the amount that I put in there. But if I got that when I was 25 and I teach until I'm 65, 40 years, I mean, we're talking about like $200,000. So I'm going to earn $200,000 over that 40 years for investing or for borrowing $20,000. Like, that's a heck of a return on investment. I greatly increase the amount of money that I'm going to make over time. Okay, so good debt versus bad debt. Excuse me. Yield's just very simply, if you hear the word yield, it's return on investment. We'll refer to that quite a bit. You'll see it in Yahoo, Google Finance. When you're looking that up on the stock market game, you'll see yield pop up. It's not a yield sign. This is just a simple return on investment. Stock is an actual ownership in the corporation. So if you buy one share of Amazon for $3,400 or whatever their current price is, you are technically an owner of that business. Are you a large owner? No. Are they going to ask you whether they should relocate their headquarters from one city to? No, they're not going to ask you anything like that. You do get voting rights as a shareholder, but you technically own part of that company. So part of the profits that come from that business go to you, whether that's in the stock price, whether it's in a dividend that we will get to as well. Mutual funds, pool of diversified stocks. So that is investing in many different companies, not just one. So mutual funds are pretty cool. We'll talk about it. I actually really like index funds, and we'll get to that in the second and third section. Bonds, kind of like an IOU. Corporations issue bonds, governments issue bonds. Think low risk, low return, but more of a guaranteed return, right? A business can always go out, and you could be out all of the money that you invest in that one particular business, but a bond is going to be a little less risky. Again, risk versus reward. Higher risk, higher potential reward. Lower risk, lower potential reward. So bond is definitely lower on the interest, or the yield, I should say. All right, about the stock market. Stock prices change. They fluctuate throughout the day. We see that in the stock market game. Some days they go up, some days they go down. Sometimes news comes out and the stock price just melts, or sometimes it just takes off. Go look at Van stock since the Squid Game thing came out. I mean, it's just been going crazy. They've been getting a ton of action on their company, and yeah, it's absolutely crazy. Stocks are definitely more risky than bond. Your general investment strategy is to buy low, sell high. So, usually downturns in the market are the best time to actually buy. That's usually when people freak out and they sell because they think their investment's going to zero. Well, that's really not the case. It's like buying. I consider it buying on clearance, right? We hit a little recession. We hit a market correction. Prices dip, kind of like in the pandemic a year and a half ago. What a great time to buy, right? Everything was on discount. It's like, it's going to the end caps at Target and finding all that stuff that's marked down like 75%, 50%, 25%. You get to buy on discount. It's great. Using coupons. There's a relationship between risk versus reward. We're not really going to talk about that all too much. We'll get to it. All right. Very important. 2 ways that we can make money off of buying stocks. Number one, some companies issue dividends, which is a share of profits given to the stockholders. Not all companies issue dividends, right? These dividends come in the form of a check or a direct deposit. So let's just say, and we'll end up looking up some here in a little bit. But Coca-Cola. Coca-Cola has a dividend, I want to say it's something like 55 cents. So if you own one share of stock in Coca-Cola, when they issue their dividends, you get 55 cents. If you have 2 shares, you get $1.10. 4 shares, you get $2.20, right? You can see if you had thousands of shares, you could get a pretty nice dividend check. Now you can take that check and you can use that. You can buy other investments. You can go buy scooters, or what I encourage everyone to do is what's called the DRIP, which is a dividend reinvestment plan, and you reinvest those dividends so you have more shares of stock, and you can have partial shares as well. And then when dividends come out the next quarter, typically they come out quarterly 4 times throughout the year, you'll get a larger dividend and you reinvest that, and then you have more shares, and it just compounds over time, and basically you end up with more shares of stock, which pays you more dividends. Hopefully the dividends go up as the company continues to show profits or make profits. And yeah, dividends are awesome. Usually they're paid quarterly, and they should be reinvested. Dividend reinvestment plan, the DRIP. Johnson & Johnson, this kind of shows you, if you were just looking at the stock price for Johnson & Johnson, it returned 114% over the last decade, which puts it behind where the market average return is, around 180%. So you're like, why would I buy Johnson & Johnson? But you add in those dividend reinvestments, and all of a sudden it actually outperforms the market, and it returns about 197%. So Johnson & Johnson, great dividend stock. Yeah, pretty good company to invest in if you go look at their stock history. So that might be something you want to add to the portfolio, even though they have had some negative news with their COVID vaccine lately. But yeah, overall, Johnson & Johnson just does a lot. They make a lot of medical devices, pharmaceuticals, like Neosporin, Tylenol, those types of things. Like those types of things that you're just going to use no matter what. You need to use those, or you're going to use those when they're needed. All right, the other one's capital gains. Capital gains is just a fancy way of saying when you sell your stock for more than you purchased it for. So if I bought a share of Amazon for $3,400, I sold it for $5,000, I'd have a $1,600 capital gain, right? If I sold it for a loss, I would have a capital loss. I can write off my capital loss as money that I lost from investing. If you do make money, you are subject to a capital gains tax. There's a long-term capital gains tax and a short-term capital gains tax. We'll cover that as well. But you do get taxed on dividends, and you do get taxed on capital gains because those are returns from your investment. All right. To review, if you don't have this in your notes, you need to have this in your notes. 2 ways to make money off of investing in stocks, index funds, and mutual funds. Number 1, dividends, share profits distributed to your shareholders. Number 2, capital gains, right? Selling your investments for more than you purchased it for. 2 ways, super easy. Good debt versus bad debt. What's an example of each? Good debt, something that's either going to appreciate over time or end up making you more money, increase your chances of making more money over time. Bad debt, something that is going to have a high interest rate or something that is going to depreciate over time. Good debt could be a student loan if it increases the amount that you'll make more so than the amount that you go in debt. Also, something like real estate could be good debt as well, starting a business, depending on what business and how it's being ran. Bad debt, worst debt you could possibly have is credit card debt, super high interest rate. Another bad debt would be car loans, because cars depreciate over time, right? Every day you drive it, it gets older, it gets miles on it, it gets wear and tear, so on and so forth. Risk versus reward, higher risk, higher reward, lower risk, lower reward, and then paying interest versus earning interest. If you're paying interest, you're making somebody else rich. If you're earning interest, you're using your money to become wealthy. Again, you're paying interest, you're making somebody else rich. I don't encourage anybody to pay interest. I encourage us to budget, just like we did in the first unit, save our money for investing, and then use that money to make more money. All right. And again, we do this all so that we can do great things with our money, that we can have a positive impact on our families, that we can be there for people in our community, people in our parish. And so give and you will receive. Your gift will return to you in full, shaken together to make room for more, running over and poured into your lap. The amount you give will determine the amount that you get back Luke 6:38. All right. Thanks, guys.